Welcome to the Capital Discussions Trading Group 2. I'm Tom Nunemaker, and today is the 10th of January, 2017. So welcome, everyone. Nice to have you here. And we were just talking about the rally and John Locke's, I guess it's similar to a road trip, Andrew?
Yeah, along the same lines. He calls it an unbalanced butterfly. I'm not sure about the terminology because, I mean, the way I understood a broken wing butterfly is a butterfly with the same amount of credit spreads and debit spreads, but just different size. I always thought an unbalanced butterfly is one where you have different numbers of credit spreads and debit spreads. But I don't know if that's, just what I was used to or if it's the official terminology. But, yeah, I mean, his
I think
trade
that's a
is,
ratio butterfly, if they're different numbers.
well, whatever. His trade.
A name is a name.
Yeah, it's an SPX trade, and it's similar to a road trip, except there are very well-defined rules, as opposed to the road trip, which is more like an M3. It's kind of there's guidelines rather than strict rules to adjusting it, and the trade, I was interested in the trade, and I went back and I'm in the process of doing a big back test in the Russell, and I actually put a live position on, so I can show you. Let me go.
So is it just a pure butterfly with no calls like an M3?
Right. It's a broken wing butterfly. Let's go to the report. I think this is what we want to see, right? So I've got 52 trades in my back test so far. 44 winners, 8 losers. It's not a high yielding trade. I mean, the average profit, I'm doing a back test with 10 lots. So, the average profit is a little over $700. But it's got a nice high win rate, and it's kind of interesting because, the winners are bigger than the losers, which is not always the case with some of these option trades.
That's true.
And you just have to look at it once a day, and there's very little. There's a little bit of discretion, but very little. It's pretty well defined rules. So,
Andrew, if I read that graph correctly, you've been in the trade an average of 7 days on the winners?
No. Let me go back. I'm not sure.
The average
Yeah,
duration?
that's winners in a. That's I think that's
Consecutive wins?
consecutive, and yeah, I'm not. This is not. This can't be the duration 7 days. To be honest, I don't know what that is, but it's not. It's not the duration, because normally you're in the trade for 30 days.
Okay, thank you.
This is. I mean, I know the bottom is consecutive wins and losses, so I guess this is. I don't know what that is.
Sounds like it's time for a Lynn question.
Yeah. I have to go back
and we go to their help files.
Yeah, I have to go and look at, and for the 52 trades, $36,542. We can go.
And I do apologize for interrupting.
Yeah.
That just jumped out at me very quickly, and I go, whoa, wait a minute here.
Yeah. Let's go. I mean, these are the trades that, Normally, the trade is put on at 56 days, and it's taken off when the next month is at 56 days. Some of these are very simple. Just, you put the thing on and take it off with little or no adjustments. And sometimes there are, a lot of adjustments. And even with a lot of adjustments, the trade still made money. Uh, there's a few of them. This was a lot of adjustments and one of the bigger losses. Here's another one. A lot of adjustments and still above average profit. Here's one where the thing, you put it on and you took it off, and one of the higher profits. So, this trade, so far, I've gone back to the October of 2012 expiration. I've been working my way backwards. So I'm back to 2012.
So how would you characterize this difference with, say, a road trip?
It's similar, except there are pretty well-defined rules, and you gradually, if the market continues up, you gradually roll the thing up.
Yeah, that's a difference. Dan doesn't like to roll up the butterfly.
Yeah, and for the downside, you if you reach certain parameters, you have put protection on, and once the market moves below the short strikes, you take the position off and you re-enter as if it was a new trade, with a starting position. You're always starting with the upper longs at the market. So, to me, the downside, rules are a little easier. The thing I had trouble with the road trip was always that downside, what to do. When to put the protection on and when to take it off. So, the difference here is that you're aggressively rolling the position down. As soon as the market goes below your short strikes, you're closing it out and rolling down, unless you're very close to the next expiration, in which case you just take it off and wait, to start the next month. And so this is what I have on right now. Now that's what it looks like right now.
How much of a debit is that relation to the whole margin required? It looks similar to the road trip, about 5% range.
Yeah, I haven't been doing road trips in a while. I was used to the road trips earlier last year where you were getting very small debits. So, this to me is a lot more than I was used to, but I would imagine the road trips now, it's fairly similar. It's the same setup. It's just, it's a 60-40 setup, but it is in the Russell rather than the SPX.
And it's starting a little bit closer to expiration.
Yeah. Well, 56 days as opposed to,
like 70 to 85.
70, yeah. Yeah. I mean, one of the things I noticed is that the money tends to come into the trade once you get down past 70 days. Once this next month comes in past 70 days, the money starts coming into the position because this P&L has all come in within the last 3 or 4 days. A week ago, the trade was only up a couple of $100.
Now, is this something that John has released yet, or is he kind of in his test kitchen, as Dan Sheridan used to
It's
say? Or
well, it's a course. If you're a premium member, um, you have access to the course.
I see.
He probably will be selling it at some point, but it's actually the course is ongoing right now. Uh, there's still, I think, one more session, which actually I think is tomorrow, Wednesday. I think the last session is tomorrow. It's kind of tempting to, with the profit twice the average profit, it's kind of tempting to just take that money, even though it's a little early.
I imagine since you're starting with that upper long at the money, the yields are a little bit higher than the road trip.
Well, on a 10 lot, as I said, I've been averaging about $700. I don't know, what have you been?
How much margin is that? About 20,000.
Uh, yeah.
So
This
what's that?
this cost me $2 when I put it on.
I put on a March monthly trade today in the ES futures options for 90 cents.
I put this on. Let's see, the 22nd. I put this on the 22nd, and it's kind of interesting. It took me a while to get filled on it too, which I guess I take, was a good price because, the first batch got filled at 1528, and the last batch didn't get filled until 1547. I got filled in pieces, and I paid $2 for it. I like trading the Russell better than the SPX. The commissions are cheaper, and I just like trading that market better, even though it's been a little tough lately. So, I should be in this trade until a week from Friday, but it is tempting to take that profit.
Michael says a little tough.
Well, the thing is, the profit could be higher. Some of the P&Ls were over $2,000. Um, you never know. And by the same token, this the market could have a big move and the profit could disappear too.
How long have you been trading it live? Is this the first
This
one?
is the first. This is the first one I put on. Yeah. Yeah. As I said, I've done a pretty big back test, and I'm actually still going through with the back test, but I've got over 4 years of back tests so far, so I felt comfortable enough to put it on.
How do you handle it when you have a big move down right after you put the trade on?
Well, if you have a big move down, one of two things is going to happen. If the move is not huge, then you'll end up putting put protection on. If the move is huge and you go past your short strikes, you'll take it off, take the loss, and put the trade back on, reposition it, as if it was a new trade. One of the things I noticed about the back test was that so many times after you do a downside adjustment, the market turns around and heads right back up. It seems to know just how much to move to force you to do a downside adjustment. It's funny. The 4 years that I've done the testing, the market hasn't moved enough to, really cause a huge loss. But I guess the potential is there. If this was 2008, 2009, I would not be doing this trade. I'd be doing bearish butterflies. But it's a good trade because it'll handle choppy markets and it'll handle uptrending markets. You just you won't make as much money, but I guess you could say the same thing about the road trip too.
Yeah, and the road trip design is basically, just you make a little bit, just don't lose any.
Right.
Maybe make 2, 3, 5%.
Yeah, I know. I can see some things popping up, but I don't. Oh, this okay. Let's see.
Bodan wanted to see my.
Maximum consecutive is the biggest number of consecutive. In other words, if there were 3 losses in a row, the max consecutive losses would be 3. If there were 6 losses in a row, it would be 6. Yeah, I am using the trade ID. Let me show you that, as a matter of fact. It's really a handy thing. This is the new trade ID column. So every month, I just use a different ID, and then it will show up in the reports that way. The nice thing is that it gives you, more choices. If you're using letters or numbers, you kind of, you're limited to how many ways you can sort the data. Whereas with this, every month is on here separately. The one thing I don't know is how the old R column works, because OptionView preferentially uses the trade ID now, but you can also use the R column. What I don't know is if you can reuse, the letters or numbers. Let me show you what I mean. Like right now, I'm not using the R column. I'm using the trade ID. But, for like the December 16 trade ID, you can sort things by R column as well. Let's say the first position you put on could be number 1. The first adjustment could be 2. The second adjustment could be 3. What I don't know is, can you reuse those numbers now for January 17? Can you, start all over again with 1, 2, 3, or do you have to go, 4, 5, 6? I haven't had a chance to find out about that. I don't know if anybody, knows the answer.
Well, I think the way it used to work, it probably still does. If you had an R code that you reuse, but the first trade has closed, like it's past expiration, then it keeps them separate. But I think if you have an open at the same time, then it can cause problems.
Right. Right. But now with this trade ID, I would think you should be able to reuse the R column as well.
I would think so.
So, it's great because you can take a specific trade now and then break down the components by R. So OptionView got something right for a change.
Yeah, I asked Len about that trade ID a long time ago, as probably other people did too. nice to see you finally got it going. And Brian said there's bugs using the trade ID and the R column, but Len's working on fixing it.
Yeah. I mean, it's nice now because, I like to use, just one account for all my trades, live trades. And so now it gives you the ability to have a lot more trades on there and to identify them too. Makes it much easier.
Yeah, I like it. The only problem I didn't like is the sorting is alphabetical, so I add a numeric prefix to it
Okay,
so it's
yeah,
sorts
right, yeah.
correctly.
Yeah. Yeah, yeah, I mean, there's all sorts of tricks. You can add I guess you could add a symbol too. Um,
Yeah, numbers sort pretty well though.
yeah.
See table at the bottom. Oh, new release. Right. Yeah, so if you go to that link that Brian pasted in the chat, the new release, he has a logic table of how he handles things.
Yeah. This particular trade actually doesn't have a profit target. You're supposed to, put the trade on and take the trade off by time. It does have a maximum loss, which is $250 a butterfly, but it does not have a profit target. It would be interesting to go back and see what happens if you do use a profit target, because there were some trades where the profit on the trade was up over $1,000, and then the market moved in the last week, and the trade ended up either breaking even or even some small losses. So to the upside, you're rolling up the short strikes, and you're also rolling up the lower longs if you run into margin problems.
It's easy enough. Any other questions about this trade for Andrew? I guess not.
I don't know if he answered mine. I didn't hear it. Does he always hold it until the next expiration is at 56 days to expiration and then exit?
Yeah, normally you do. The exception would be if you have to do a roll up or a roll down and the following month is 59 days or less, then you wouldn't do the adjustment. You just close out the trade. And the other thing that I noticed in the back test was there were a couple of times where you're supposed to put on put protection, and I couldn't find a put that limited the loss enough, and in that case, I closed out the trade. But 95% of the time or more, yeah, you're putting on the trade and you're taking it off and putting the next one on the same day.
Do you ever have two on at once or just one?
No, you never have two on at once because when you're ready to put the next one on at 56 days, you're taking the other one off. I mean, that's according to these rules. Obviously, you could take these rules and change them and do whatever you want.
Yeah,
if
you
you're
could
doing
use
this
weeklies.
if
right?
you're doing this with weeklies, I was just going to say, then you'd have you'd have two or more on at the same time. But if you're just using the monthlies according to the rules, no, you would only have one on. But this is just a starting. It's like everything else. It's a starting point. Um, you know, my experience has been that people who are really successful tend to take something like this and make it their own in some way. You always end up changing something. I mean, I see, with the road trip, Dan has evolved from the way it was first presented. He's doing things a little differently. He's added things like the in and out adjustment. That's what successful traders do. You're always adapting to the market. You're always looking to find some better way to do something.
In fact, Dan and I were talking about black swan type defenses, and he came up with an interesting a butterfly that he added to the one of the open class trades. Basically, you're protected if you have like a 1987 type of crash.
Yeah. Well, hopefully we will never see another one of those, but you never know.
Yeah, I know. We do have circuit breakers like the limits, but if a nuclear bomb goes off in the wrong place, or markets are closed for a week, I don't know if those limits would actually work.
Yeah, well, I mean, we went through that with 9/11, and the results were not as bad, I think, as 1980. 1987 was a strange year because everyone talks about the stock market crash, but if you go back and you look at the silver chart earlier in the year, silver had a big rally, and in one day, silver dropped $4. It went from like $11 to $7. I mean, literally in less than an hour. So there must have been something in the air that year that predisposed markets to crazy moves like that.
Yeah, hopefully we won't see those again.
Yeah. Well, according to the standard random theory, we should have never seen that, but we did.
Yeah, I guess people want to see that trade that Dan put on. Let me take the presenter role a second.
Yeah.
Let's see. Oh, let me know when you can see my screen. Maybe I need to share it. Let's see. Share screen. This one. Should be coming up shortly. See it? Okay, good. All right, so let's see. I wanted to show a couple things. What I'm doing um, for the trade IDs, I assign prefixes based on the expiration, and what that does, then when I go to the list of trade IDs, let's see, let me bring an account that's got multiple trade IDs in it. Option view, work with me. Oh, there it is. So now it sorts in chronological order, which is, I like to do that. And that's, you just have to define your own sorting method, but numbers sort really well. So that's what works for me. As far as the trade that Dan put on, I think, oh wait, no, that's the futures options. Well, before we do that, we can just look at the futures options trade I put on today. So I did a 2225 by 2175 by 2100 and 2090. I split it, and that ended up looking like, oops, not that. I'm in the wrong account. Let's see. That was the test one. Yeah, it looks like this. I like blue, so sorry. Better contrast. So that's what this looks like. It's not too much of a debit. I think this one was 90 cents, and this was a 10-cent credit, that butterfly. So overall, fairly low entry price, and it meets that 5% that we use as a guideline for the debit on the upside. But lots of time to go on this. And markets, I think I put it on when it was around break even, so it's already moved up $6. And then the road trip trade, that was on SPX. Let me pull that up. That's this one. So here's the road trip trade right now for March 17th, but if I zoom out a bit, you can see the structure. Actually, there's a missing strike, I think. Let's see, 20. Yeah, where is it? Hang on, let me look at the class page real sec. $19.25. It's an ES. No, I can't find it. Maybe it's just not on the open yet. Well, basically, it was a butterfly down at. Oh yeah, the strikes are off here. That's why I think. Let me look at the T log. SPX. Here it is, 1825, 2025, 1925. So I'm missing some strikes here. 1825, 1925. Oops. I forget what the other ones were. Yeah, there they are. Yeah, so it has this butterfly shape. Let me really zoom out so you can see it. So it kind of looks like this. So if you do get a big black swan type of event, you're heading uphill if you have a massive crash, but it doesn't affect the P&L too much. I forget what the actual debit was that Dan paid for it. Let's see. I can go down 1925. So these are the butterflies, a 1 by 2 by 2. So it costs a little bit to put that on, but that's the net effect of what it did. So with the goal being that if you do have a 1987 type of crash, it doesn't completely wipe you out. See if there's any.
The protection is basically coming from that long put.
Right. Yeah, you're an extra long put. It doesn't affect the trade management too much up here, but the idea is that it just doesn't go down to minus 18,000 if you have a huge loss or drop in the market. So that's the first time Dan's put that on, actually. And I think we're going to be putting those on in the accounts that we trade too, because we don't want some of the funds out there that trade money, big events like that go out of business the next day, and we don't want to do that. So we want to keep everybody's money relatively safe.
Tom, it's Steve.
Yep.
How you doing?
Good.
Have you and Dan tried to snug that lower butterfly up a little higher? Have you played around with that at all?
Again, this is the first time Dan's done this, so I think he's still in kind of the test kitchen mode with it.
Okay, thanks.
I can ask him. How much margin did it use? Let's see. If I put this on by itself. $300 to put that on.
I mean, the credit spread is tiny, so.
Yeah. So it's a $300 insurance policy. And Eric says, does OptionView calculate required span margin for ES options? It tries to. I don't know how close it gets. Depends on your broker. I know Dan's using thinkorswim, and the OptionView margin numbers are always different than what thinkorswim has. But it's not too far off, maybe a few $100s. But that trade that I did earlier today in the ES, this one, I think it was about, at IB, about 20,000 in margin for this thing. And that's the wrong account. So let me go here, put it in the right account. So if it was a Reg T trade, it would be 76,000, and the span margin was somewhere around here. So less than a third of what the Reg T margin would be. Obviously, if the market moves down, that's going to increase. But the initial span margin was about a third or less than what the Reg T would have been.
Well, that's always the danger of using portfolio margin or span margin, is that if you're fully margined, you can get a margin call very quickly.
Oh yeah, and this is for a $250,000 account, so it's not really pushing it for this guy.
But there are so many people who are always pushing to have the maximum amount of capital in play, and
it helps your returns until it doesn't. Yeah.
Right, exactly. It's always the leverage that kills you.
I don't know why OptionView. That's one thing. At the end of the day, I usually use the 4 o'clock Eastern times because these T+N lines kind of get crazy. So BackTrader is what I use for like the class, for instance. But then they look normal. So anyway, that's where this one started. I'll probably add an out trade and maybe some kind of hedge to it. But this is the initial salvo, if you will. Just getting in the trade. Then I had to start the meeting, so I'll do more later today, but this is where we are right now. And I guess it would have been about, 200 contracts, so probably a little bit less than $300 in commissions for this.
Tom,
Yep.
on that out of the money butterfly that Dan put on, is he trying to hedge a little more than normal now? Is that what he's doing? Are we worried about the inauguration or the new things in the next month or so?
Well, I don't think it's anything like that. I think it's just that, he's playing around with hedging ideas. Oh, that's ES. I don't want that. Back to SPX. Just to the existing. And maybe make this a little wider. So, yeah, I mean, he's just trying to find some kind of cheap hedge that will not blow out your account if the market has a massive move down.
Okay.
I think that's just the goal.
What is the difference in having that put with and without the butterfly?
Let's see. Well, you start getting some help here. Let's try this. Let's take these off and just leave one long put. See what that looks like. Then you can compare them. So fairly similar, actually. You get more of a lift on a smaller move down than you do, because that long put here is actually helping you sooner than this one is.
Right.
So if all you're protecting is the black swan event, then you can do it for $150. and you get similar protection down in this area. If you want a little bit more protection on a, say, a 10 to 15, 20% move down, then this butterfly is a better idea. So I guess it's like Jim says, what are you trying to hedge against?
Right. Yeah. Catastrophe or a normal bear market in a short amount of time.
Right.
The for something like 9/11, I guess the butterfly would work better. For something like 1987 crash, it wouldn't really matter.
Yeah, they'd be pretty similar. Although, if these are the T plus zeros, it was down 22.7%, which would be something around here. So you'd be down minus 4,400, 4,500.
Yeah, the butterfly is still giving you a better.
A little bit better. Maybe another 1,000 or 1,500. But the point is, with either one, you're not blown out.
Yeah, I'm curious what happens if you got a huge pop in volatility, though.
Well, that's going to help these longs.
Right.
You could, if Dan's hedge costs $200, then you could do it another way. You could say, well, let's take 2 of these for $150. That's 300. Then what do you get? Then if you overlay them, now you still have the dip down here, but you start getting protection, and pretty good protection, a lot sooner. The other way you could do it would be, let's see, just buy one $3 put. Now you can compare all of them. So the $3 put's not too bad either. So again, it's like Jim said, what are you trying to hedge against? So, and how much do you want to spend for the hedge?
Right.
It's clear a bit. Maybe one more line. Yeah, and Mike says, isn't that what Dan Sheridan just buys thinking put? In fact, a lot of market makers did buy units, so they would be buying, these $1.50 puts. A friend of mine who was on the floor of the Board of Trade said they always had back spreads on. And I think OptionView does adjust the IV for market moves. They try to anyway. And yeah, Brian, the IV spike, I'm not sure exactly how OptionView is factoring that in or not. I suspect, though, if you have more long puts, like, say, 2 of these, then you're going to get a better lift when that vol crashes or the vol spikes up. The more net long puts you are, the better.
I think what OptionView is doing is it's looking at how volatility has changed recently, and it's assuming if you go into the model, there's that CEV.
Yeah, enables CEV modeling.
Yeah, I think the CEV controls how much it projected change in volatility, and it's constantly looking at what's happened, in the past. So if you get an extreme event that's completely out of the realm of experience, it's not going to handle it very well because it just has no data to go by.
Right. Uncharted territory.
Yeah, if you follow those CEV numbers, they're constantly changing as the market changes every day.
I started to mute myself. Somebody's trying to call. Waited till they gave up. All right, so that's it for the for that trade that Dan put on the hedge. But it's always good to talk about hedges. That said, I mean, look at the price. That Adam Grimes is saying, here's a nice bull flag. He's looking on the weekly, monthly charts, and he's expecting significantly higher prices in the market over the next year or two. And I don't disagree with him. Doesn't mean we can't have some pullbacks, but it does take one big event like a 9/11 to rattle the market. So even though everybody thinks it's going up, hedging, especially when the vol's low, isn't a bad idea.
Yeah, well, the S&P has been going sideways for a while now. It's establishing a trading range, and if you look at that trading range, a measured move breakout, up or down is going to take it, the size of that trading range. So,
yep,
we could go, above 2,300 or below 2,200 pretty quickly on a breakout.
If you guys would not mind, there's a trade I'd like to get your opinion on.
Sure. That's the whole point of a trading group, Tim.
Okay.
And,
I didn't know.
share here. Yeah, we have time.
Okay.
Let me just find you on the list here. Let's see. Oh, there you are. You are now
The presenter. Okay. Let me share my screen. And why does that have to show? Okay. This is a trade that I'm working on with somebody. And ignore the history. We did a lot of stuff, but it's a 4-lot, and we put it back on when the market was about 2170 or something. I don't know. He got a little aggressive and did some verticals right off the bat to flatten the line a little bit. Then we decided to take most of those out. That's what this is here. So and the rest of it is all just reverse Harveys. We did the in-out debit spread on it here, and then we added a baby butterfly here. So this is where this trade stands right now. We've done a lot of work on it, but I'm wondering if there's more I can do on this trade now without hurting a good 80 to 100 point downside without reaching max loss. That's what I'm thinking about on this. Wanted to show this and see what everybody thought.
It looks interesting. Can you tell us some more details? Like how far out are you going? How are you adjusting it? Do you start out with those two humps, or is that something that you adjusted to? Or
Yeah. If I take off a bunch of stuff, we can at least look at what the graph like. The numbers aren't right. There's the beginning.
This started out as that big butterfly, right?
Started out like this, yeah. And then we started with we did this 1-lot reverse Harvey to start out to not have so much low on the upper line.
How far behind the market was that butterfly originally?
That's what I can't remember, but I think it was probably about 30 points. Market was probably right about here somewhere. It was November 19th, maybe, if I remember right, or November 30th, somewhere in there. I don't have that in front of me right now. Maybe it was December. I can't remember. It was about 80 days to February 17th.
When February was 80 days?
I believe that was about right.
Okay.
And so this is how we started. Sometime a little bit later. See, I wish Thinkorswim would put date and time, or allow you to put date and time in these simulations. That would help.
Okay. February was 80 days on November 29th.
Oh, 29th. That sounds more about right. It was in that range. So then a little bit after we opened it, we did this reverse Harvey here. And then...
Okay. The SPX was around 2,200
okay.
November 29th.
Okay. This was a debit spread. Essentially, it was a capital efficient move to roll up some of the bottom longs, but it was put on as a debit spread to try to, we were worried a bit about the T plus 0 line, and this is, in retrospect, maybe we got a little aggressive on doing that, but in so doing that one, it reduced the margin as it usually does, and it did flatten the line a little bit, so we realized a little bit after that maybe that was too aggressive, so we took out two of them, and you can see here we sold them for we bought them for 95 cents. We sold them, two of them for 65 cents, so we lost $60 on that deal. And then after that, we started doing these reverse Harveys. We did one here, we did one here, and this was also a modification to reverse Harvey because we had essentially moved a 2160 down to a 2140 with these two trades here, and realized that I didn't want to leave it like that, so we actually put one back. Which put us in a position where we've done 2160, 2150 reverse Harveys. Now, the line is, the expiration line is a little bit below zero here. We did one more reverse E. And then we were looking to juice the trade up a little bit because we wanted to see if we could increase the potential. So we did this in-out debit spread thing here. That doesn't, is that right? Something doesn't look right with that. Oh yeah, I'm sorry. Way up here. I'm sorry. I was looking at the graph wrong. So it did and that of course market was right here when we did this. We got a pretty good platinum line here, but just not having a lot of juice in this trade. So we added the top butterfly. That's how that second butterfly structure appeared in there. And that's where we stand today.
The problem is that
I know that if you look,
the market is so far away from that original butterfly that, the whole trade at this point is basically, what you put on above it.
That's exactly right. So this morning I looked at removing this whole bottom structure here, and theta goes flat, delta goes up a little bit, and then we're left with this structure. So I think that's one possibility. The problem with that is I couldn't know where to reposition it to that didn't create a huge debit and reduce this expiration line even more to a point like where I don't know if I could recover it with more reverse Harveys or adjustments.
What is that,
so I didn't like that idea.
What is that butterfly worth at this point? I mean, is it worth taking it off? Because right now it's basically a lottery ticket.
Yeah. So on my other screen, I would get about 5 cents debit for part of it and 20 cents credit for a smaller part of it. So it's worth basically nothing. Here I can.
Yeah, it's at this point it's so cheap that it's it's probably just worth leaving it on as a lottery ticket and I mean, forgetting about it and just concentrating on the portion of the trade that's near the market.
That's my thought as well. So, if we go forward, what's about 10 days, and we have some profit start to come into the trade, and, we've worked on it so hard and it's gone up so much, that might be acceptable. It's only a 4-lot trade. But do you guys think that we could do any kind of a unbalanced condor or call credit spread or something? What are your thoughts on that? I think we could if we want to go with it.
Yeah, it's kind of a narrow structure too. You don't have a big range to play with as far as making money goes.
Yeah.
Did you see Eric's comment about thinking about just taking it off for a scratch and start over?
Yeah, I didn't see that, but yeah, that's always a choice. Yep. We would have to start over with a March 30 or something, but that's always a choice here. One of those in-outs, we spread part gets to $2.65, we're going to take it off. So it raises by $265. So the top line will come up just above zero in that event, and if we didn't do anything else. Right now, I've been watching the debit spread part of this is quoting about 350, right? 330, so it's not quite yet time to do that. But so the line isn't as low below zero as it looks like if we keep going up.
At 38 days, you have to start thinking about the.
Well, here, I'll just do it this way. Go ahead.
I said, at 38 days, money's going to come into that trade if we get any kind of pullback. Right now, the market's, right at the top of the structure. We get any kind of pullback, money's going to come into it. But, the negative gamma is going to start to work against you if we move too much.
Right. Here's a call credit spread that might be a possibility, but now we've got to worry about the line on the top even more. Although we have to go up about 30 points before we worry about it, but
In this kind of market, call credit spreads are always a problem because we've been moving enough where the spread doesn't give you enough credit for the kind of moves we've been having.
Yeah. Yeah. So I'm reluctant to try that. Maybe the thing to do here is to sit tight, and if we get a little bit of profit within 10 days or something, or target exit, then do that.
Yeah, with that butterfly to the downside, I wonder if you could, take a little risk by, doing some put credit spreads below the market. Try to, bring some money into the position.
On the bottom one?
Yeah.
Way down here? Well, we could sell one of these 2150s and buy 2120. We're going to take a look at that.
I don't know what kind of money is left in those credit spreads down there. 21, 30, 40,
Yeah.
50.
So it looks something like that. $1.07. Did I do that right? Yeah, 21.50, 21.20. There is some credit there. That'll raise our line. Now our break even is, or halfway to max loss, which would be $200. The way I'm doing this would be up to 22.23. It's a little closer than I would like. It's currently at 21.88. But that's a possibility.
I don't know if it brings in enough money to take on that downside risk. That's that's really a personal preference. That's
Right.
a big spread to sell for less than $2 credit.
Right. Right. I'll show you what close and lower fly does if you bear with me for just a second. I have it modeled on another screen and I'm going to bring it over. Let's see. Hold on just one second.
I mean, how much closer to expiration do you want to hold this thing? Are you willing to take it, close to expiration?
We're safe, and if we're getting paid for doing that, yeah. But if we're not, if we only get another $50 by waiting, no, I'll be out. Okay, so if we import, make sure I did that right. Here's what closing the lower butterflies look like. So we got it's kind of split because of the strikes, but we get even for the big part of it and 25% credit for the little part of it. Then we're left with this structure, which isn't very wide. Exactly right, but halfway to break even, $200 is down to 21.71, so it lowers it a
Yeah. What does that T+0 line look like?
little bit.
Like a week from now. That
So a week from now is
Yeah, Neil has a good question about would you be able to close the lower fly and how much slippage would you have to give up?
probably be some true, right? Well, in 10 days,
by the time
our T+0, our 200-point line is now down 90 points from where we are. We'd have some profit zone. Not much.
Yeah. I mean, that thing's not going to, that thing's not going to be a big profit maker until you get pretty close to expiration.
Yeah. Yeah, if I go forward to drop out. Okay, there we go. February 3rd. Yeah, we're not going to reach a lot of profit here no matter what happens. Even if I didn't close this, we might, in this range, we'd make even more if I didn't close it, but looks like a profit target exit date. just wanted to show this and, see what we're working at on this one.
Yeah, I think you really have to decide. Here's my potential profit if everything goes right. Is that worth the risk holding the position? Compared to what could go wrong and what you could lose.
Well, thanks for sharing, Tim.
Maybe not.
The other thing is that lower fly is basically your whole trade as far as what the margin required is. You take that off, you get $7,000 worth of margin back. So maybe there's a better use of that.
Exactly. I think that's exactly right. Yeah. So it might.
Yeah, we're a little bit over an hour, so it's probably a good time to stop. I appreciate you sharing that, Tim, and good discussion with the group. Tomorrow, Jim's going to discuss his leap rolling diagonal at 10 o'clock Eastern, and then an hour later, he's going to talk about butterflies and iron condors. So Jim's going to be busy tomorrow. But if you don't catch those, they'll be recorded, and we will see everybody next week, same time for Trading Group 2. So thanks, everyone.
Is there an email for the 10 o'clock? Is there an email that goes out? How do you
Yeah, there should be one going out if you're on the roundtable list.
Oh, okay.
And you can also go to the calendar on the class or the members page and join from there too.
Okay, so actually there's two roundtables with Jim tomorrow.
Yeah, one at 10 and one at 11.
Okay.
But they're going to be recorded too, so. All right, well, thanks everyone, and we will see you next time.
Thanks, guys.